Welcome to Talk Tickers, where we break down the earnings calls that really matter. Today, we're digging into ICICI Lombard's second quarter results for fiscal year 2026. Let's get right into it. All right, so here's the big question on everyone's mind. ICICI Lombard just posted a pretty big earnings beat. So why is the stock lagging the market? I mean, profits are up, but the share price isn't following. We're going to dive in and figure out exactly what's going on here. Okay, first things first, let's look at that headline number. Profit after tax, what the analysts call PAT, came in at a whopping 8.2 billion rupees. Now that's a solid 18% jump from last year, and it sailed right past the 7.73 billion the street was expecting. So on the surface, a really strong profit number. But here's where it gets interesting. Take a look at this table. You see that strong profit number we just talked about? And they even declared a nice dividend of 6.5 rupees per share. But then, look at the gross direct premium. It actually declined by almost 2%. So profits are up, but the core business of writing premiums is down. That's the central puzzle we've got to solve today. And that puzzle leads us right to the core theme of this quarter. It's all about profit over premium. Management is making a very deliberate choice here. And this slide, it shows you their strategy in action perfectly. On the left, you've got that headline number, down 1.9%. But look what happens when you strip out the low-margin stuff like crop insurance and mass health plans. Their core, more profitable business, that actually grew by a healthy 3.5%. So they're intentionally shrinking in some areas to grow stronger in others. It's a classic case of quality over quantity. And you don't have to take my word for it. The CEO, Sanjay Mantri, said it himself. He emphasized profitable growth and pointed out that their combined ratio is way better than the industry average. That's them saying we're not just writing business, we're writing good business. So the next logical question is, how do they actually measure that? Well, they do it with this key metric right here, the combined ratio. Now, don't let the term intimidate you. Think of it this way. For every dollar in premiums an insurer collects, how much do they pay out in claims and expenses? If that number is under 100, say 95%, they made a 5% profit just from underwriting. So for an insurance company, a ratio under 100% is the goal. It means you're profitable before you even start investing your money. So looking at their numbers, their combined ratio was 105.1%. Now you're probably thinking, wait, you just said under 100 is good. And you're right. This means they had a slight underwriting loss. But there's a reason for it. This quarter was hit by 730 million rupees in what they call cat losses. That's catastrophe losses from things like major floods. If you pull those one-off events out, their core ratio looks much better at 103.8%. It shows the underlying business is actually quite stable. Okay, so this disciplined approach, how does it fit into management's bigger picture? Let's take a look at their playbook. Listening to the earnings call, a few key themes just kept coming up over and over again. First, that disciplined underwriting we've been talking about. Second, they're laser-focused on a return on equity above 20%. And where's the growth going to come from? They're betting big on two pillars, motor insurance and retail health, all while pushing for more digital distribution. It's a very clear, focused plan. And they're not just focused on their own operations. Management is also really optimistic about the future. And a big reason why is that they see some significant tailwinds coming from recent government reforms. Specifically, they're looking at this big GST framework overhaul. Now, what does that mean for them? Well, it's expected to lower taxes on vehicles and make health insurance premiums more affordable. You put those two things together, and it could seriously boost consumer spending. And you guessed it, the demand for insurance. It's a potential game changer for the whole sector. And hey, this isn't just wishful thinking. We're already seeing some early green shoots. Check this out. During the recent Navaratri festival, two-wheeler sales absolutely surged, up 36% from last year. That's a huge number, and it's giving management a lot of confidence that the second half of the year is going to be strong. And going back to that discipline theme, even within their motor business, they're making smart moves. They are actively shifting their focus towards more profitable private cars. As you can see, private cars now make up over 54% of their motor portfolio. That's another example of them chasing profits, not just volume. All right, so we've looked at the good, the bad, and the strategy. What does this all mean for the stock? This brings us to the next call. First off, let's just be honest about the stock's performance. It hasn't been great. You can see here it has significantly underperformed the Nifty 50 index over the past year. So if you're an investor, that frustration is completely understandable. So, looking forward, what are the key things we need to watch? Well, first, we need to see if those strong festive sales numbers actually turn into higher premiums in Q3. We'll also be watching for those catastrophe losses to hopefully normalize. And of course, we want to see continued growth in that high-margin retail health business. The market's reaction to the dividend will also be telling. And all of this sets up the one critical question for any investor. In a market that seems obsessed with growth at all costs, is ICICI Lombard's disciplined profit-first strategy the right call? And, more importantly, does this recent underperformance actually represent a buying opportunity? So here's our outrageous but plausible trade idea. How about a pairs trade? You go long on ICICI Lombard, basically betting on their discipline and long-term profitability. At the same time, you'd short one of their high-flying competitors, one that's chasing market share but has much weaker underwriting margins. It's a pure play on discipline versus growth at any cost. We think the market is really overlooking the strength of their balance sheet here. You've got these positive regulatory tailwinds kicking in and a management team that has proven they're committed to long-term value, not just short-term hype. For all those reasons, we are initiating our coverage with a rating of outperform. So that's our take on ICICI Lombard's latest quarter. Look, they are clearly playing the long game, focusing on building a rock-solid foundation instead of just chasing empty growth. We'll definitely be watching to see if and when the market starts to reward that discipline. And, as always, please remember, this is not financial advice.